Hello, everybody, and welcome. I'm Mike Coe, and this is Open Interest. Tonight, we will talk a bit about Netflix, and we'll get to that in a bit. But first, a tweet reminded me today that I should address some important points about technical analysis and how and why we use it to inform the options structure we choose. The trade structure we're going to examine is the vertical call spread, both debit call spreads and credit call spreads, and how technical analysis can be used to inform which one is more appropriate depending on the setup. First, let's take a look at the difference between debit and credit call spreads. Okay, so the critical difference, let's start with the debit spread first, and that is in the column on the left-hand side here. When you purchase a debit call spread, you are going to be buying a lower strike call, and then to help finance it, you're going to sell a higher strike call. In this case, your premium is always going to be an outlay. You're always going to spend money to put a trade on like this. And this is expressing a bullish near-term thesis. And it is a bullish near-term thesis because for this to be profitable, the stock is going to have to rise, if you're going to hold it until expiration, through the lower strike of the call that you own by at least the total net outlay that you spent. And let's contrast that with a call credit spread. So in the call credit spread, you're going to do the exact opposite. You're going to sell the lower strike call. You're going to buy the higher strike call. You're going to end up collecting premium. And this trade is neutral to bearish in the near term. Now, it's neutral because if the call credit spread is sold out of the money, you can collect all of that premium even if the stock just goes sideways. In some cases, if the call strike that you sold is above the current stock price, it can even rise a little bit and you can still collect all of the premium. And of course, you will certainly collect all of the premium if the stock declines. So what we can see here is that in the case of a debit spread, you're making a bullish call and the stock needs to rise in the near term to see profits. In the case of a call credit spread, you're making a neutral to bearish bet, and the stock can go either sideways or down, or in some cases, it can even go up just a little bit, and you can collect profits. You will lose money, however, if the stock goes up sharply. Okay, so with that, why don't we take a look at the tweet that prompted all of this and some of the technical calls that we get to examine because of it. So the first one came from Dan Nathan, also known as Risk Reversal. He's a colleague from CNBC. We spent many years on options action together. And he tweeted, "I've been very fortunate to work with Carter Worth since 2010 on options action and fast money, and now on Market Call," which is, by the way, an online show that he does, which I encourage you to check out if you're interested. I'm asked all the time, how do I get more of his work? Well, here you go. Old-fashioned technical analysis, nothing slick, just charts. And then he points people to Carter's website, which is www.worthcharting.com. I would say it's worth checking out if you're interested. I would also point out that that is a somewhat institutional product, and that's Carter's background. And what prompted all of this was a tweet that responded to Dan from Tony Ritter. And he said, okay, file these. And he references IBM and he references Netflix, very important this week for sure. And he provided links to two videos where Carter discussed these stocks on CNBC. And why don't we go ahead and take a look at those?
Here's the final chart. What do we know? A big move off the pandemic low, got ahead of itself, got ahead of the market, and is now basically backing and filling for almost a year. That high that you see where the line is drawn is back in January, and we are toying with the prospects of breaking out.
Okay, so this piece that we're looking at here was CNBC on September 3rd of last year. And what is Carter's call here? Carter is making a call that the stock has been range bound for a period of time, has reached a critical juncture and is now likely to break out. So he's basically saying two things. Number one, he's chosen a direction and he is saying that it is imminent and that the stock is going to move higher and is going to do so soon, possibly sharply. This is a trade that sets up well for a debit spread. And in this case, because it was September 3rd, I looked out. Now, I've dealt with Carter for 13 years on CNBC, and he frequently actually worked with firms that I've worked with in the past that goes back 20 years. And his time horizon is generally inside of 60 to 90 days. So, he typically doesn't make intraday predictions or make 1 day or 1 week predictions, but 90 days would be pretty much as far out as it would go. So on September 3rd, if you heard this, what might you do? You might look out to November expiration. So 60 to 90 days, halfway between that is 75 days. November expiration was about 75 days from when he made this prediction. So buying, it was about 590 or so, I think, when he discussed this, maybe a little bit above. So maybe the first out of the money strike that you would look at would be the 600. So I was looking at buying the November 600 calls. Those were about $33 that day, and selling the 650 calls at $16. That was the price also on September 3rd. So that's a $50 wide call spread, and the net debit would be about $17. Now, that pays about 2 to 1. I'll quickly point out that that's a little bit more than we sometimes look to spend on vertical call spreads. You'll often hear me discuss these kinds of things on CNBC, and I'll target to get about 25% is what I would look to spend, a payoff of about 3 to 1. But that's not always possible in stocks like Netflix. And the reason is Netflix is a highly volatile stock. The options premiums are elevated. And oftentimes the debit spreads are going to be a bit more as a result. So why don't we now take a look at his thesis and how it played out. So just as a reminder, on September 3rd, he pointed out that this stock, and he actually, if you want to, you can go back and watch this piece. He talks about several stocks where this was the case. Range bound for a period of time, poised to break out. What happened? In fact, almost immediately after he said this, he was right. Netflix did, in fact, break out. And if you take a look at the period that I'm looking at here, that is exactly 60 days. So I went from September 3rd to November 3rd. So this move that we're looking at took place just over his 60 to 90 day time horizon. How did the November call spread that we were putting on, how did that perform as a result? So here's a price chart. You'll remember we were risking $17. It had about a 2 to 1 payout. Unsurprisingly, because the stock broke out very shortly after he indicated this critical juncture, the call spread actually ended up going to its maximum value. If you held this all the way to expiration, which I think was November 17th, so 74 days-ish or so, 74, 75 days after he made this announcement, then you would have seen profits. This is basically a picture-perfect setup. Critical juncture, expecting a move, and picking a direction, ideal for a debit spread. Okay. What about the IBM trade? Now this one he made on January 5th, and here his thesis is a little different. Let's have a listen.
Given back some, IBM has been really a dog, and this sharp rally leaves it at a difficult level. Let's look at a chart or two. So the first one is IBM over the past decade or thereabouts, and no judgments, lines drawn. Now look at the exact same chart with some lines drawn, with a judgment rendered. We have gone precisely to a downtrend line that's been in effect since the peak that you all were talking about in 2011, right? The stock was 206. It hit a COVID low of 86, and now it's rallied a lot up to 138. So next chart, this is the third of four. This is even longer term. You have a fairly clear level here, which is to say, after a move like this to a level of overhead supply, taking some chips off the table as a long only player, I think makes sense. We're writing calls or some other measures taken. Short selling, I'd initiate here, and if and as it moves above the downtrend line, then you've got to acknowledge error and close the short.
Okay, so how does this prediction differ from the one that we were looking at in Netflix? So here he specifically cites that it is reaching a difficult level, overhead supply. He is suggesting that you fade the stock, but really what he's talking about is that it has reached a level and it's not likely to breach it. And this is different than saying you've reached a level and it's going to breach it. It's going to do something and it's going to do it quickly. Here he's saying it's reached a level and it's not going to. And this is a situation that sets up well for a credit spread, because you can choose a direction and say, we don't think it's going to go to that area. It's reached resistance, it's not going to get there. So this is where we would set up a credit spread. So it was early January. I was looking to March. Again, we're looking at a similar time frame. We're looking to get out in that 60 to 90 day time horizon that he typically targets. I was looking at selling the March 140 calls. Those were $4.80. Buying the 145 calls, those are $2.90. The net credit is $1.90 on a $5 spread. That's collecting 38% of the spread width. Now, here again, where we try to buy vertical spreads, anticipating a big move, we want to spend a little, try to make a lot. Here, because the most you can make is the amount that you collect, and the most that the spread can be worth, less that amount is the most you can lose. You want that amount to be as much of that spread as possible. So 38%, that's a pretty good number. So now why don't we take a quick peek at how this played out. Okay, so here we are. This is where he was predicting that it would reach, that it had reached resistance, and it was a long-term, a downtrend resistance level. What happened over the course of the next couple of months? IBM did indeed retreat by about 12%. Now, because his chart was such a broad area, we have to zoom in here a little bit, but that's actually a relatively long period. We're looking at a period of 60 days. So that's 2 months after he made that prediction. Now, interestingly, IBM then actually returned to that trend line. And you'll remember that he had pointed out that if it returned to and then broke through that trend line, if you had a short on, you would want to cover it. But also notice that the stock, actually, that stock is not higher than it was in January. So how does this play out for the short call spread? And we'll take a look at how that performed. So if you sold that call spread, remember you collected about 38% of the $5 distance between the strikes, went against you, I think, the first day or two, but thereafter, thanks mostly to decay, but accelerated by the fact that the stock actually retreated, this call spread went to zero or very close to it well before expiration. Now, this chart shows what would happen if you held that short call spread all the way to expiration, but an important point, don't do that. Almost all the money that you could possibly make had been made about 60% of the way through this trade. When you get into that situation, just cover it. You can redeploy your capital elsewhere. You're risking a lot to make very, very little. In any case, it happened to work out here, but that's an important point. The max profits had been achieved. Okay, so where does that leave us? A couple quick things. When you're dealing with vertical debit spreads, you identify a critical level, you identify a direction that something is going to move. So your prediction is that you're anticipating a move, hopefully a relatively sharp one. That's when you want to lay options premium out. That's a good situation to use a call debit spread. If you think a stock is reaching a difficult level, it's unlikely to make its way through it, that is a situation where you want to use the credit spread. You can collect the premium. So another quick point, what does Carter have to say about Netflix now? So he was actually on CNBC. I don't happen to have this clip, but I encourage you to go back and watch it. And his point was that it may actually have gotten to a situation where it is so bad that it's good. He's not making a fundamental case for Netflix. He actually says that when he's on the air. This is not a long-term buy and hold. What he's saying is that now that a few days have passed and we have one more day to go, I think tomorrow's going to be the third day since this washout, that it might set up for a potential bounce. And what's interesting about that is that when we take a look at the options flows that we saw today, Netflix traded about 4 times its average daily options volume. It was actually the 4th busiest single stock option in the US listed options markets today. There were a lot of puts trading. Most of those actually expire tomorrow, so they're not even going to be relevant for any of you watching today. But if you take a look at the options that expire next week, and in May and in June, what we are seeing are some people potentially playing for a bounce. The 220 calls that expire next week were the most active contracts actually that expire next week, and those were buyers. In May, we saw an institutional seller of 1,000 of the May 175 puts, collecting about $2.60 a contract. So that's a credit trade. Remember, you're taking premium in. So what do we remember from this conversation? That you don't expect the stock to go through that short strike. So in this case, that trader is saying, I don't think Netflix is going to go below 175. I'm willing to collect $2.60 a share to take that bet. And bearing in mind that the stock was 218-ish, I think, around the close, that's about a 20% decline from where the stock is. So the person's giving themselves a reasonable buffer there. And then going out to June and further data, we did see some fairly big purchases of higher out of the money strikes as well. So the final thing I want to leave everybody with, though, is this. And that is that technical analysis is a very valuable trading tool. It is intended to take a look at price action to establish what a stock may or may not do in the relatively near term. And we can contrast that with fundamental analysis. Fundamental analysis tries to identify the intrinsic value of a security and is typically part of an investment strategy. Now, if you want to buy and hold a security for a long time, or if you want to take a long-term short position, you're probably doing that as a function of some fundamental analysis. How and when you enter the trade is something that you might use technical analysis to help you with. I'm Mike Coe. Thank you for watching Open Interest. If you like this kind of content, please like, subscribe, hit the notification bell, and I'll see you in the next one. If you liked the content, please consider subscribing to the Open Interest YouTube channel. That's youtube.com/Open Interest. And of course, you can also follow or tweet me at Michael_Coe, or go to our website, www.openinterest.pro. Thanks for watching.